Hello folks, welcome back to another session. Most of the traders wonder why the market moved to the upside just after dropping a few pips below the previous support, and why the market moved to the downside just after going a few pips above the resistance. So in this video today I will explain why your stop losses get triggered most of the time and why it happens. So this technique is called turtle soup. Once the trader learns this technique, there is no way he can't make profit in the markets. It is one of the most powerful techniques discussed by ICT and most of the professional traders who has worked in hedge funds and banks. The market makers and the big players use this technique to their advantage, and most of the retail traders are caught before they even make profits in the market. So in this video, I will explain how you can use this technique to your own benefit and how you can milk the market using this technique. The turtle soup technique in retail mindset trading is called a stop hunting. Like here you can see the market has made relative equal lows. The market was meant to move to the upside at this support point, but it didn't go to the upside, went down and triggered the stop losses of the traders who bought the market at this area. And once it hit the stop losses, the market went to the upside as we can see on the chart. So it happens most of the time, and the retail traders are caught almost 80 to 90% of the time. But in this video, I will show you how you can take advantage of this technique, as it is one of the most powerful techniques and strategies in trading. Here it is another example. The market has made a high at this point. So the market was meant to go to the downside just after hitting the previous resistance area, but it went to the upside a few pips above the previous resistance, and just after moving a few pips above the resistance the market reversed and completely went to the downside. So why this happens? Because the market makers and the big players knows where the stop losses are, where is the liquidity pool, and most of the time they will come to grab the liquidity, and it is a must because in order to move the market they will need that liquidity to move it. So this happens every day, and I can show you countless examples of these turtle soups and this stop loss hunting technique. So stay tuned and learn how to trade this technique. Here we can see the market at this point breached the previous resistance, and it made a pin bar, and after breaching the previous resistance the market down to the downside. The market completely turned its direction to the downside. So here we know most of the traders make the mistake when the market approaching the previous resistance, they sell at the previous resistance point, let's say at this point, and they place their stop loss just above the previous resistance. The market knows the people sentiment. The market knows the market players, the big players know where the stop losses are and where the liquidity pool is. So when you place your stop loss, let's say above the resistance, they will most of the time trigger it. They will take your stop losses, they will take the liquidity pool, they will grab the liquidity, and the market will turn in your favor just after hitting your stop loss. So that's the point where you will regret. Here is another example we can see. This was the previous high, and the market went a little above the previous resistance, the previous high. We can see the small wick, and just after breaching it, just after taking the stop losses, the market went to the downside. And what it did at this point, it created a low, it created support, and it also breached the support by 2 or 3 pips, took the stop losses and went to the upside. This happens every day. We can find countless examples in every pair, in stocks, in commodities, on every chart, on every time frame. Here the market has created relative equal lows. The market went a few pips below the relative equal lows, grabbed the liquidity, triggered the stop losses, and went to the upside. So let's say if traders have bought the market at this point, they usually place their stop loss exactly 1 or 2 pips below the support. The big players know this, the market makers know this, they will come for it, they will trigger your stop losses. And just after triggering your stop losses, just after the liquidity grab, the market will turn in the direction in which you predicted it. But at that moment, you will be out of the trade, you will be out of the movement. Here it is another example. It was a high created by the market. The market went a few pips above the previous high, the previous resistance, and just after breaching it, after the liquidity grab, the market changed its direction to the downside. So usually, as I say, we can find thousands, hundreds and thousands of examples. This was also a previous high. It was a major high. The market knew it. The traders, most of the retail traders were waiting to enter the market at this point, which is a previous resistance area, and they would have placed their stop losses just above the resistance area. So what the market did, the market went and targeted their stop losses, grabbed the liquidity, and most of the traders predicted the market correctly. But at that point, when their stop losses got hit, their stop losses got triggered, the traders also get disheartened, they get disappointed, and they don't trade the market when their stop loss is triggered. So we can say their prediction was correct, but their stop loss was small and they didn't let their trade to breathe. As I said, here we are having another example. The market has created this high. At this point, the market went to the upside, took the stop losses, grabbed the liquidity, and changed its direction to the downside. Here is another example. Here was relative equal highs. The market went to the upside, grabbed the liquidity, and the market turned its direction to the downside. And same, we will be having examples of support, the market breaching the support area. We can see the market has created a major low, a major support at this point. The most of the traders would have traded the market at this point. They would have took trades at this point. They would have placed their stop losses let's say below the exactly 2, 3, 4, or 5 pips below the previous support, previous low. The market knew it, the market came for it, market triggered it, market targeted their stop losses, and we can also call it the SSL trade, which is sell stop liquidity rate. I showed these examples on H1 time frame. I can show you these examples on H4 time frame too. There will be lots of examples. Mm, let's say yes, here we can see. First, let me clear it for you to have you better understanding of the market, for you to better understand this technique turtle soup, because it is one of the most important trading aspect, trading technique, trading strategy, which the market makers and the banks, the hedge funds, the big players use to their advantage. So here you can see the market has created a low at this point. What the most of the traders, most of the traders would have done at this point, they would have traded the market, they would have bought the market at this area, and they would have placed their stop losses exactly below the support, exactly below the previous low. So the market came down. Let me remove it. The market, you can see the market here, you can see the wick, the market came down, the market triggered their stop losses, and the market went in their predicted direction. And let me show you again what happened at the upper side of this chart. The market created a high at this point. The market created a resistance at this point. So most of the traders would have traded it, considering it, thinking of it as a double top pattern, and they would have placed their stop loss above the resistance, exactly few pips above the resistance. The market knew it, the market came for it, the market triggered their stop losses, the market took their stop losses. It was a liquidity grab. Then the market turned into a bearish move. So this was for your Euro USD. I can show you examples in USD JPY. I can show you examples in every pair. You give me a commodity, I can show you examples in that. You give me stocks trading, I can show you examples in everything. So why it happens most of the time that the market triggered the stop losses? Because we as a retail trader think that the support and resistance will hold the market from further moving up and from further moving down. But that's not the case. The market will always go a few pips below the previous support. Even if it is not on the first touch, the market will go on the second touch. It will go deeper in on the third touch, but it will always go few pips below the previous support. It will always go few pips above the previous resistance in order to grab the liquidity, to clear the liquidity pool, and to take your stop losses. It is, we call it buy stop liquidity rate and sell stop liquidity rate too, or simply you can call it liquidity rate. So we saw the market created a low at this point. It is a daily time frame in the pair USD JPY. Most of the traders would have considered it a double bottom pattern, and they would have traded at this level, at this area. They would have placed their stop loss exactly below the previous support and previous low. thinking that the market will not trigger it, the market will not breach the previous support, but the market did it. The market took their stop losses and they predicted the market will move to the upside. They were completely right. Their prediction was true. Their prediction was correct. The market went to the upside. Uh, so when it happened when the market took them out of the move. So when they got kicked out of the market, they lose their confidence. They lose their confidence to enter the market at this point, and they will be not likely to get in the move. They will be thinking that their stop loss will be triggered again, and that is the tactic, that is the technique which is used by the market players. So it happened at this point too. Here the market created relative equal lows. The market created support, but the move came a little down, took the stop losses, went to the upside. This is what happens most of the time. This is what happens most of the time in the week, and this is what happens most of the time of the day. So this is the manipulation. The market won't hesitate to manipulate the charts. So better you understand this technique and use it to your own advantage. So now I will show you how you can use it on at your own advantage. First of all, you mark the previous highs. Like, let me clear it to show you again. This area was a high, so we will mark it. What happened? The market went a few pips above that resistance, and now we know that it was a manipulation. It was a turtle soup, and it was a stop hunt technique. It was stop hunting. And how we know it? Because you can see this bearish candle just after the formation when the stop hunting happened. So we would have entered the market after the formation of this bearish engulfing candle. We would have placed our stop loss above this manipulation area, above this area where the manipulation happened. So we could have easily targeted 1:3 trade. Sorry, 1:3 or 1:4 trade. So that's how we gonna use this technique. We will be looking for bullish engulfing candlestick, bearish engulfing candlesticks. We will be looking for pin bars like hammers, like shooting stars, and like dojis. To use this technique to our own benefit and our own advantage. I show you a sell model. Now let me show you how to buy the market after the turtle soup. After the stop hunting, we saw the market created this low. We saw stop hunting happened, manipulation happened, the liquidity grab is happened. So, and here appeared a hammer candle. So we would have entered the market exactly a few pips, let's say 1 or 2 pips above this candle. And we can also place our pending order. We would have placed stop loss below this manipulation area, below this stop hunting area, and we would have targeted 1:2 or 1:3 trade. Let's say um, it was a 160 pips as a, so we would have targeted this much move, which is 450 pips. It is almost a 1:3 trade. So I hope this video has helped you, and now you know where to place your stop losses, where to trade the market, and where to enter the market, which technique to use, which candlestick to use for confirmation. So this is it for today. See you in another video with another topic and another strategy. Take care.